Hey guys, and welcome back to Tax Tips number 4. I'm Dan, Chartered Accountant and co-founder of Ember. Now today what we're talking about are those big asset purchases that you might make in your business. We know they can be a little bit daunting because they're a big outlay, but what we're here today to tell you is that HMRC recognizes this, and what they want to do is provide you some tax breaks. So if you're a designer thinking about that next big MacBook purchase, you can really excel your business, and what we want to do is help you out with understanding how you can deduct that today. What we'll cover off on today is what is a capital allowance, when can you claim it, how to claim it, and for the extended version, what schemes are available to you as a business owner to make these deductions. So what are capital allowances? Well, they're essentially a tax break that are offered to business owners who just purchase assets that they're going to use over multiple different years. What it results in is 100% deduction of that asset's value against your taxable profits. Now what that means for a sole trader is that they can actually reduce their income tax and Class 4 national insurance. And for a limited company, you can reduce your corporation tax because you're reducing your profits by the value of the asset. When can you claim it? Well, it's basically on those larger ticket items that you purchase for the business. Things such as the laptop, a camera, graphics card, or any other higher value assets that you're actually using over multiple different years. So that's not your train ticket into work, it's not the meal that you buy at lunch, and it also doesn't include cars or vehicles because a whole different set of rules actually apply to those, which we'll cover off in another tax tips to help you out. How does it work? Well, in the business world, there's a little concept known as accounting profits, which confusingly differ to your taxable profits. The reason that is that HMRC can set their own rules for your taxable profits, which sits separately to your accounting profits. Now, what we're talking about in this case is when you buy that asset, the full value of that asset in the first year of purchase actually gets reduced from your taxable profits, but it doesn't from your accounting profits. What happens in the accounting world is it goes onto your balance sheet and gets depreciated over the useful life of that asset. Now we're going to get into the detail of the schemes that are available to you as a business owner, which can literally save you millions. First one up, the annual investment allowance. The AIA offers you the ability to deduct the full value of the asset in the accounting period in which it was purchased. That can be any asset such as plant, machinery, equipment that you use in your business, and you can deduct up to £1 million against your taxable profits. That £1 million resets every accounting period as well, so you get it year on year. Remember though, it can only be deducted once for the asset itself. You can't reclaim an asset year on year. Things that you can't claim it on are examples such as leases, buildings, land, cars, all those sorts of things you can't claim it on. And if you have an adjusted accounting period, which means if you've got a shorter or a longer accounting period than 12 months, you also have to adjust the £1 million. So if you've got a 9-month period, multiply the £1 million by 9 over 12. The second most commonly available scheme is known as the first year allowances. Now this is quite similar to the AIA in that you can deduct the full value of the asset in its first year. However, it applies to a whole set of different assets, meaning that you can actually claim the FYA and the AIA in the same accounting period to maximize those deductions. These items include greener assets, such as low CO2 emissions vehicles, and also any energy-saving plant and machinery that you buy for the business. Now there are other capital allowances that are available to you as a business owner, which we've covered off in a handy article in the description below if you're interested. They don't tend to return you as much value as the ones we've covered off on today, but they do allow you to look at a more diverse range of assets. Otherwise, thank you so much for joining. I'm Dan, and this has been our Tax Tips number 4, and we'll see you next time.